Hello everyone! Welcome to another industrial property analysis video. Episode 2 of our industrial property series. And this is
Charlene.
my name is Vivian. In our last video, we actually talked about quite a few things. Hey, the view very bad 100 plus.
So not many industrial investors around. Hello.
Where are you? In our last video, we actually talked about quite a few things regarding industrial property. One of it is industrial property really all lose money, meh? And we also shared about who can actually buy industrial property. Actually, Charlene, do you feel that there is a lot of people that think that today, if I don't own a company, actually I don't need an industrial property?
Correct. They don't know that there is another way to buy property without owning a company.
Yes, exactly. And in fact, there is quite a few people out there who is suitable to buy industrial properties. Who are they?
Those that maybe they have already owned a HDB or condo, then they just want something to invest on. Maybe they have a sum of money in their bank that they want to invest, but they don't want to sell their house anymore because maybe they have a big family size. They cannot afford to buy another one because of the ABSD, and they want to invest somewhere.
Correct. In our last video, we also talked about how to buy industrial property with very minimal down payment. But due to some time constraints, it is quite hard for us to go very clearly based on that. And the last one, which is the most important, we shared about how to use a correct framework, which is what we call the 70 framework, to analyze individual industrial properties. Because by following this 70 framework, if a property actually checks most of the boxes here, can I say that it's a safe industrial property to look at? Those that usually got profits they follow this particular checklist. And those that cannot make money, right, are the ones that usually don't follow all of these or maybe don't fulfill some of the important factors here in this checklist.
Or the most important that we mentioned previously was the trade mix, right?
Yes, correct. Remember to like and subscribe to our channel. Last video is talking about freehold properties, which is why we also find it very important to run through with you using this checklist to compare between a different type of property,
which is more common as well actually. It's our leasehold.
So what is the most common problem behind finding a freehold? Many people want freehold
Of course.
But the main issue about a freehold industrial property is actually about
the quantum.
Last video, we talked about city goal. Average freehold
sale is about, for city goal, just use city goal, is about 2.7 to 3 million. Minimally, the down payment, 800,000.
$800,000 for most Singaporeans is a amount that's very big.
And it's cash.
Correct. Cannot use CPF. I think I put it in a better way of saying it is, if I have $800,000 cash, I actually want to focus on my house first, which is why I feel that maybe based on a freehold property, it is a bit out of reach for most of us. That is where a leasehold property will be more suitable, especially for those of you who are looking to invest in your very first property as part of the stepping stone, right? Which is why we are going to run through the 70 framework using leasehold property. But honestly, leasehold property also have its own pros and cons.
Lease decay, everyone will be saying, wow, what if I buy 30 years, then how?
In residential, we talk about 99 years, people are really worried. Can you imagine industrial property, 30 years? 30 years is very short. So does it make sense to go for a 30 years leasehold property? Is it going to be unprofitable?
We will cover the numbers and figures later on in some case studies.
And most importantly, when we talk about such properties, it is more important that all these properties follow this 70 framework.
No matter what you do, be it freehold or leasehold, you still have to follow this 70 framework, which we will always use this in all our videos.
Towards the end of this video, because there are many case studies to reference to, we are going to use this project, which is Gate Plus, as a reference as to how we analyze leasehold properties as well. Without further ado, we address the elephant in the room first. Because why?
What is the issue? Just now we already mentioned.
Yeah. So what we say freehold property, no lease decay, I can pass to my children. This one, leasehold property.
Clock is running. Just now you put here, clock is running because of the lease decay. Oh, this is one of our number 170. Let's say if you're holding on a leasehold property in terms as an investor, what will be your ROI be?
What is the problem about buying into such leasehold properties? Hey, Charlene, then comes the next thing. a lot of things in the market right now, there are a fair mixture. There's freehold, there's leasehold. So why is it that it's 30 years leasehold? Why do governments want to do it this way?
I think government is also controlling the launching of 60 years lease because they don't want land hoarding. As per this news, right, industrial government land sales program, they are releasing more of a 30 years lease. But previously, there are 60 years leasehold property. I think maybe they are just restructuring. Singapore is just so minimal.
But I guess I feel that the demand is still generally more towards residential. Every 5 years, our government will review our master plan, right? There could be times where due to demand, due to like population, there will be changes in how the government wants to plan our land. I guess this is also part of the long-term plan in a sense where, like what you say, they don't want a particular trade to hold on to land that may not be suitable.
Correct.
But of course, they offer like lease extension also. That's according to the industry that they are in or the business they are in, whether it's still relevant in the next 5, 10, 20 years or not.
Because if let's say it's JTC land, right? If they want to extend their lease, they still need to submit a lot of documents and your company profile and all that to let the JTC to determine whether they want to approve to this extension or not. It's not so easy. That's why government is also controlling all this very much. And also, previously there is a lot of launches, 30 years lease, right? Business owners also make a feedback that after the building process construction of 3 years, they only left 27 years. So government still taking this feedback. That's why they launched this additional 3 years of lease tenure, which is why we are also using Gate Plus. I think they are the first one to be having this 33 years lease, which means these 3 years of construction, you still have 30 years fresh lease at least. Not so bohua.
I think we can all agree that our government is actually always monitoring very closely to our needs as well. Of course, when we talk about this, that is based on government's point of view. But as people who are buying into something like 30 to 33 years lease, it's honestly quite scary. I ask myself also, if I want to buy something like this, it's quite scary. Because what happens to people who are just a bit more worried? Especially since our line of work, we do a lot of research and analysis, right? We also put ourselves in the shoes of, for example, if let's say we want to buy this for ourselves, if I want to buy today, there will be a high chance that I want to sell also. Of course, I want to plan accordingly to, if this investment makes sense for me to hold all the way. But I also want to ask myself, what if halfway through I want to let go of this property? What happens?
We still want to have the flexibility. We want to have control of our liquidity.
Yeah, because property, most importantly, it is already inflexible. The last thing we want to do is for us to be so stuck, right? Which is why over here, we actually will use some case studies to think through this process together with you as well. That is why me and Charlene, we think we should really ask ourselves and at the same time lay out the numbers for you to see.
Actually sit down to ask ourselves what are the questions that we general also will ask if you were to buy a property. What happens?
What we see in the slide over here. What happens when I really want to sell? Will I be stuck in this process if I buy a short-term leasehold property?
Because what will happen is the impact of lease decay. We keep on saying that. And if let's say you were to sell, this lease decay will impact our future buyer's loan. This is the main thing that we should look into.
And why we always want to do this is because the impact on our future buyers will impact the demand that will be on our property. If let's say the demand is high, of course we can sell high, right? But if demand, we already know that it will not be so highly sought after as compared to residential. And now the demand is made even lower, then that is a risk on the buyer side. Like for you as well. We are going to touch on how does lease decay impact on the future buyer's loan.
Assuming, we're just taking one case study scenario. Let's say you are holding on to a 30 years old lease property and you are selling after 5 years, which means your remaining lease will be 25 years. Assuming your future buyer age is roughly about 35 years old, can I say that based on the maximum loan tenure, we will base on their maximum age to cover up to 65 years old? So they can loan by right is 30 years old. However, we have to look into the thing that is their remaining lease of the property is actually now at 25 years. So can bank loan? So how will bank determine the loan tenure? we will base on two scenarios, which is one, the age, which I mentioned 30 years. Another will be based on the remaining lease of the property. Bank will only take whichever is lower. In this case, they will only take 25 years. However, do take note, some banks remaining lease, they need at least 5 to 10 years.
This could be shorter.
Effectively, this one maybe it will be up 15 years. That's your maximum loan tenure. These are the things that we have to highlight because this will impact on the future buyer money installment. See, for example, 30 years, your money installment is healthily at 2003. 25 years, 2007, increase another 500. Another 5 years minus off will be 3,200 money installment. This is about 1,000 more.
When we talk about $1,000 more, how does it impact different groups of buyers? Today, if let's say I'm a small business owner, I want to buy into such an industrial unit to use, then this $1,000 more could impact very greatly based on a small business, right?
Correct.
If I increase the loan furthermore to maybe 2+ million or 3+ million, then the installments can increase by $2,000. $3,000 respectively because the loan amount is actually bigger, right or not? This is also another impact for people who are looking to rent out because let's say your tenancy is $4,000. A 30-year remaining lease versus a 20-year remaining lease, it will mean that my cash flow will be greatly impacted as well, isn't it?
Correct.
By working out this, we hope to actually help you to see why is it that lease decay actually will affect your demand as well. When we are talking based on rental, this is where I feel that the next question is to ask. When we are talking about lease decay, right? This is actually the risk. The future buyers will also weigh out for themselves. For this lease decay, how can I be compensated? And in many cases, how these buyers will be compensated is by
the rental yield.
Rental
which
yield.
is why we will go through some case studies to show you how do we derive rental yield. Of course, by that, we will be using profitable and unprofitable projects to show you if you will be holding a 30 years old leasehold property, what will be the outcome for you. Let's say you are holding on as per rental basis. We're using Mega at Woodlands, a profitable development. This is actually 30 years from 2014. You can see it's a very healthy profit at about 100,000 to 150,000. And the holding period is just 3 years to 6 years.
Wow.
And the rental is about averagely, let's say about 5,000.
But now that I see their purchase price is only 500 to 700 plus thousand.
These owners, they bought in 2019 to 2020. They are actually resale buyers.
This is actually better than some residential project.
Right? And the quantum is actually lower than residential project.
The capital outlay is also much lower. Annualized return about 4%.
About 4%. Of course, not every day is honeymoon, rainbow, sunshine. We also have to show you unprofitable development. This is actually a pioneer point. Also, same 30 years TOP since 2014. The loss is from 20,000 all the way up to 230,000. This one 810,000. I'm not sure why lah. This one maybe under declare. This is the rare situation. But then we see the average loss is about 100K. Rental is about 3,005 to 3,008. Why are they performing very differently as well? But even if they perform differently, what we want as an investor is to look into the numbers. Because if you are buying it for rental, you want to count your rental yield, right? So what will be the cost of everything? How do we actually derive whether is it profitable or unprofitable? What will be your net return of equity?
If you notice towards the leasehold properties, they tend to be lower quantum based on these two case studies. And this usually gives the owners who are holding on to such properties very much high rental yield. And just now we keep saying you should focus a lot on rental yield. So how do we actually ensure that we are using the correct numbers to calculate rental yield? Because by doing so, that will actually help us to be able to plan in a short-term or long-term holding period to see whether it makes sense to hold on to such property or it's just a waste of time. Which is why we are going to run through the exact numbers on how do we calculate this. Why we also want to share with you these two projects, right? In terms of These kind of properties, we have to acknowledge that there is lease decay. So when it's lease decay, a lot of times we will automatically relate this to what if the property does not make money? That's the biggest fear lah. Which is why our case study is going to be very interesting. Even when we were doing this, right, we were very excited as well. We keep talking about rental yield. Is this higher rental yield actually profit or not? Or is it just helping me to cover my lease decay? We actually went through this particular process. This case study will answer these 4 main questions, which are the elephants in the room. Apart from the higher rental yield, does it make sense or not? It's also about what if the property doesn't make money, followed by what happens if I want to sell halfway. And last but not least, what happens if you hold on to the property until the last day?
Until 30 years.
Because when I think about it, right, what do you think when we think about holding the property all the way?
I want to make sure that I know how much is the net numbers that I gain. Do I still gain or not? That's the question.
Correct. And am I throwing money into a sea? Because when we think about leasehold properties, it's always about, what if I cannot sell? What if I'm stuck with this property? Then how? If I hold on to this for the next 30 years, what happens?
Then for a business owner, they will be thinking that I might as well rent since I'm also throwing money. Right?
Correct.
Just now I did mention most people will know how to count the rental yield. Basically for rental yield, there are 3 components that you should look, and the most basic is the gross rental yield, which most people will know, which is using the monthly rent times 12 divided by your purchase price. Then you will get the gross rental yield. From then on, you will see that, wow, a lot of advertisement. This property can give you rental yield up to 6%, 7%, very high rental yield. But is this the case? The second one will be this. You have to calculate your expenses of your property, which is your MCST and property tax. And there are other costs such as agent commission costs, if you were to ask an agent to rent out for you. And not every day you are able to rent out. If let's say the market is not good, you also have to count based on your vacancy period. You take how long to rent out your unit? 30 days, 1 month, 2 months? Then you times 12 and divide over your purchase price. This will be your net rental yield. For investors, it's very important to know all the numbers and figures that you are throwing in, so you know whether are there any positive cash flow every month. Next, we also have to look into the cash on capital yield. What are you paying in terms of your capital, which is your down payment plus your stamp duty? So after how long will you get back? Later on, we will show you the table. We'll be using Gate Plus as a reference. So assuming this 0940, the purchase price is 851,000. This handsome little boy is our investor. Right? Sorry, there's a typo here. 35 years old, your loan tenure, because this Gate Plus is 33 years loan tenure. So by right, you can only, based on the bank, whichever is lower, your remaining lease, you can only loan up to 26 years. So taking back, how do we calculate the rental yield? So we're going to take the average nearby rental based on Gate Plus will be at Jurong area. We'll be using Pioneer Point and Pioneer Center. 2014 and 2013, the average rental will be about $3.20 and $2.59. So we'll just take an average of $3 per square foot, because Gate Plus will be a newer development among them,
which by right can command a slightly higher rental but we're just being quite conservative here.
So based on this $3 per square foot, how we calculate the rental, how we calculate our cash flow per month to make sure that we are able to know our finalized return of equity. So let's say assuming purchase price 850,000, the loan will be at 80%, which is 680,000. The deposit, the stamp duty, the legal fee, all this will be your initial capital upfront, which is your total equity, right? So taking the 25 years of 2% interest rate, your monthly installment will come out to be about $2,877. So just now I said the per square foot of this area will be about $3, right? For your rental, you times 1,615 square feet. That comes to be about 4,800 a month. I also round down so that our numbers will be easier for you to see. The gross rental will be 57,000. Now we have to look at what are the costs of holding this property. Number one, your property tax estimated we based on 4,800 times 1 year, 12, And for industrial, just to take note, the property tax is a flat rate 10%. Unlike residential, there is a different table. And maintenance fee, I'll be using a conservative 300 a month, which is 3,600. Let's say agent commission fee and your mortgage interest. So now your per year expenses will be about 25,500. What will be your net rental returns after you minus off your gross rental? Your net rental returns will be 32,000, and based on this, your return of equity will be at 16%. So what will be our net cash flow per month? It will be $924.59. It's a positive cash flow.
What do you think of this? $900.
Very positive, very healthy. Because I have been doing a lot of resale, right? Sometimes the positive cash flow can be only $200 to $300. So this is considered a healthy cash flow.
This is actually the correct way to do a calculation. If let's say you want to buy investment property to invest to rent out lah. But when we look at it, a year is just basically times 12 and all lah. So this is based on short-term rental. Then it comes to the next bigger question. If let's say I'm very happy with this rental, right? But what happens next? What happens if I want to sell? Correct or not? And there's of course many scenarios, but we just make it very straight to the point. For example, what if I want to rent all the way, then suddenly at the halfway mark, I want to sell? What happens?
So now we'll be giving the 15-year exit analysis. What if you sell halfway? We are giving a few different scenarios based on the profits, let's say earning 20 to 10% versus not earning, versus if you are losing a 10 to 20%. So this will be your sale price, less off all the outstanding non-commission fees, right? And not forgetting you will be getting 15 years of rental cash flow. What will be your final profit?
You always want to think from the best scenarios, but we're not going to just paint a beautiful picture here. We also want to show you what it really means if you were to sell this property at a loss. Assuming that rental remains the same, assuming that all of this is about the same, but we're just focusing based on the different figures. Best scenario, profit, still not bad because cash flow plus your cash proceeds, you minus your initial capital, the final profit is still this.
650,000,
not
more than
minus
half a million.
是对的。
Yeah.
You put in 200,000, you get back a profit of 650.
Which is more than 50%.
Like, how many of us can save almost 400?
More than half a million.
How many of us can save 400,000? Not easy,
No.
not easy, right? But of course, what if the property don't make money? We look at the other end of spectrum, minus 20%, right? I put in $193,000, but my cash proceeds, rental yield, I still get back this amount.
Not too bad, right?
So I think what we see over here, we're also quite surprised. Because automatically when you think about a property not making money, it's like, throwing money into the sea. But based on what we see, it's still rental income that we are talking about. Which is why we keep emphasizing, if you're buying leasehold property, most important you have to think about is actually rental income. It also goes back to, today if you go on to the property portals to find industrial property, does it mean that anything that is like a leasehold property is good to go for? No, ma.
No.
It goes back to our 7T framework as well. But of course, we also want to drive through another thing. What happens if the lease decay all the way?
What happens if we hold on all the way? So assuming there is this thing that we also, as an investor, we need to look out is the capital recovery. We hold on all the way, the initial capital that we put in, we need to know how long do we need to recover back. So assuming the rental is 4,800, I never count in inflation or anything.
Yeah, because from now till 20 years later,
we don't know.
Chicken rice also increase. How can rental not increase?
But we don't know, so we just very conservatively, we use 4,008. Let's say if you hold all the way, we put in 5 years, 10 years, 15 years. So just now, remember our initial capital is about, I scroll back, initial capital is 193,100. Approximately at 15 years is about 166,000 already. So can I say about 17.5 years, we will cover back our initial down payment. So subsequently, you say you want to hold all the way. these are the rental that you will be collecting back.
What you're trying to say is even if we actually buy this property and hold on all the way, actually we are still able to cover our capital outlay,
Most important.
and then our rental can still help us to make a profit.
Yes.
But of course, over here, we didn't factor in inflation where the rental can increase as well. And another thing we never cover is vacancy period. But which is why we never increase the rental, just to be fair for you, just to be very conservative in our numbers.
Yeah. So subsequently, can I say that after 17 plus years recovering back your capital, right, you are really like the 包租公 already. The landlord lah, just every month collecting your passive income.
So
Which
actually
if you're
makes
planning
sense,
a retirement, makes sense, right? Also links to why people are also investing in commercial. Commercial definitely means cash flow assets.
So I think it also make more sense for people who are actually looking at retirement also, just to collect rental, cover the monthly.
4,800 a month for your retirement, not too bad.
And today we are talking of a property quantum of about less than $1 million. Once you pay down the loan, actually everything that you have saved is inside the property already.
So essentially, also people will think about whether do you want to put your cash flow, the initial capital, be it in the bank as a fixed deposit, government bond, or the income property. So we will just put as an illustration. Definitely, it is still your decision, but these are the potential that you will be looking at based on the interest rates, the rental yield in return.
What it also means to you is today we are just talking based on a very conservative figure. But of course, those of you who are watching right now, over the past few years, interest rates went up so much. And it made a lot of sense for us to put in the money that could be used for down payment for a property into a fixed D. So I think in very good times, it was what, 4%?
4%.
Right? So now as the interest rates start to lower down,
the fixed deposit usually it will also lower down as well.
So
2%?
2%. So 2 to 3% is like the typical yield that you're talking about.
It's actually considered good time already if it's 2%, right? 2 to 3%.
So for property, I guess it's not saying that fixed Ds are not good, but in terms of property, it is also a longer term investment portfolio in a sense where you can think about rental yield, but also at the same time, we can also think about if let's say you choose the right property, do we actually have a higher chance to make more money in that sense? Which is why going back to this, Charlene and I actually emphasize very highly, very importantly, a good industrial property must follow back to the 70 framework, because this is where we will get a higher possibility to be able to make profits as well.
Yeah. Actually, you also mentioned just now, and even when you're holding on to a property, right, earning a profit is also like a bonus.
Correct. In residential, we also got no guarantee in profits as well. The only way you can do so is by putting in more thought process and thinking, which is why our analysis videos are always here to help you to have clarity on how to buy a safer property. And likewise for industrial properties as well. This is actually quite an important checklist that all the industrial properties that you're looking at have to fulfill. Some of the more important ones, like for example, if we are talking based on a leasehold property, is always about tenure, right? How to increase the rental is by the tenability. And we are going to run through the rest of the 70 framework by going back and relating back to this project called
Gate Plus. Just sharing with you the project information. It's actually located in Jurong, one of the new MRT line, which is along the Jurong region line that government is building. Tenure 33 years from 2025, which means the 3 years construction period done. Getting the key TOP, you will have a fresh 30 years lease. Why do I need to look at this 70 framework? Because we also want to align based on this project. How many does it check, right? Of course, number one, B2 industrial. This is the type of factories that we are looking at. B2 is quite rare in Singapore because number one, we also have to take note is the high ceiling, which most of the business owners will prefer because they can load their goods. Then, are there any transformation in this industrial area, which we want to show you based on the location map? Where is it located at for Gate Plus? Because of the new Jurong region line, we are all connecting very closely to Singapore.
So in terms of this, actually which one does it tick according to the 70 checklist?
Tick the transformation, and also transport. Got transport, we have both. One is within the development, another is out of the development. That means, is it easy for business owners or your clients to come and find you or not? How are the transport accessibility? So we show you this location map.
Why is it important? Because can I say that most of the industrial properties here, they are businesses. So for businesses, who are the ones that we really want to come find us? Our clients, ma.
Yeah.
So if our clients cannot find a way or find it very inaccessible, then how to find?
If not, your suppliers transport your goods and all that, right?
Correct. So that's why location is one of the most important thing as well, which takes the last portion of the checklist as transportation. But a lot of people have the misconception of thinking that transportation mainly just means how do people get here. But this is where a lot of people miss out the most important thing, which is the transportation within the project. Which is why when you look at an industrial property, it's very important for you to look for the brochure as well, because by looking at the brochure, the plan as provided by the developer will be able to tell you the transportation within the development, whether it is okay or not.
So just by looking at this brochure, we are able to see for level 1 and level 9, they have already built in a mezzanine space, which means it's very good for business owners, right? So this Gate Plus is a ramp-up unit. For level 1, ground floor, you are able to have 40-footer container trucks to access. So loading and unloading goods is very important. And then for ramp up, they can allow 20-footer trucks to access from level 1 all the way up to level 9. So for level 10 is actually their penthouse mezzanine units. And then next we have to see, based on the per story, right? The height limit is about 6.125 meter.
Which explains why the 20-footer can go lah. But why is it important for 20-footers to be able to go up all the way?
That means they don't need to find a cargo. Your driver have to go to the cargo lift and slowly unload and then go to the individual floor level to find your unit again to unload the goods.
So it makes everything more efficient lah.
For business, time is of money, right?
So can I say that for B2 complexes like this, maybe the older projects will not be able to provide as well?
They really have, and I see some of the older B2 developments, right? Even if just finding the cargo lift, there is only one cargo lift.
Then that means the delivery guy during peak hours have to wait to load the stock also.
So it's not very efficient for the business owners lah.
And can I say that if it is not as efficient, then this also kills the demand of future buyers or future tenants who are coming in as well.
So actually a lot of business owners, your tenant, right, they will first look into it. Where is the cargo lift? How am I supposed to load my goods? This is the number one key criteria that most of the tenants will look out for.
If you don't have a brochure like this, when you are walking your ground, we also encourage you to spot things like that. If it makes the tenants or the people life very convenient, then this also can tell in terms of our rentability, and this also can assure you in terms of your rental yield too. However, when you walk the ground, you cannot spot this or you cannot spot that, just like what you mentioned earlier, which are important, right? Then how do you feel when you are serving buyers and bring them around?
Then it's not good.
I think it's very common for investors to go in and see, oh, everything is okay, number makes sense, then can. But if these are the things that are missed out, actually to rent out is also difficult. So even if your rental yield is good, the tenantability not good, a lot of people cannot relate to being here, having a business here. This also affects you. So if you're not so sure how to actually do, you can actually reach us at our contact number. We both same. So either one of us, we will be able to help you, assist you to determine whether the industrial property that you're looking at makes sense or not, whether it's safe to go for it or not. So back to this.
Another thing that I want to highlight for this development is, can you take a look at the wall-to-wall width? So from here to here, it's actually 9 meter to 12 meter, which essentially means that you can load your goods, yes. But then that means when this unit is unloading their goods, your lorry truck is here, you are still able to have another lorry to access, because we also seen some of the developments that have a very narrow car park area. So it's very inaccessible in terms of driving through and also unloading your goods. So this is one thing that you have to take note of as well. From this, we can see the tenantability is checked. Just now we also mentioned about the transformation, the type of factory because it's a B2, as well as the transport within and outside of this development. We already checked how many? 1, 2, 3, 4.
So there are 3 remaining ones, right? So this is where we want to see based on the balance whether Gate Plus ticks the boxes or not.
So unit mix. Why am I showing you this unit mix is to see what is the average size of your unit. Because one of the key things for our checklist is this title size. Title size means you do not want to buy a property that is too small, or you do not want to buy a property that is super big. That is also very hard to rent out, or you will lessen your pool of buyers, right? So this unit mix for Gate Plus is actually quite healthy. Averagely, we will say that a healthy title size is about 1,000 to 2,000 square feet.
So this is naturally the sweet spot for B2 industrial units lah. So if you are finding one of your own, even if it's not Gate Plus, this probably is something that you want to take note of also. Because if you go a smaller size, B2 is not easy for people to use. Because B2, what is the usage for
It's a
people?
heavy usage.
Heavy usage, then too small, how to use? So when we are serving buyers and tenants on the ground, this is naturally the things that they want to look for lah. So you don't want to go for something that is very low, sometimes very cheap. That will mean that it's also very small. Then very hard to rent out also. Then very big, the quantum will be too high. And very hard for businesses to go for as well.
This is just one of the floor plan, which is at level 1 with mezzanine. So with this, you can see that there is ramp up, which means your transportation within the building to your unit is very accessible. Next, you also have to see where is the lift placement. It's actually placing at the middle of per floor, which means when your clients and all that were to come, they don't need to go one whole round. If let's say the lift is here, they don't need to travel all the way if your unit is here.
Correct. And one of the most important thing is, if you see the site plan like this, it's actually easy for most people to find your place. So to give you perspective, in our last video, we actually shared that, for example, have you ever been to Vivo City? Every time go, every time lost.
And North Point. A lot of people complain.
Correct. So this will actually deter tenants from coming in because let's not forget it's business ma. We want people to find us easily. We want our clients to find us easily. Which is why if you go to an industrial property and you find that it's very hard to find this unit, right, it's actually a bad sign for you because it doesn't fulfill the transportation within in our checklist as well. So the last key important thing that we want to talk about is actually about trade mix.
Trade mix.
Because even if the 70 framework fulfills everything, it doesn't fulfill trade mix, it is a bad property. So when we're talking about this, give you one example, it's like Caros. Caros is usually where I service my car.
So it's all car related.
car.
There's only one type, cars.
So when there is one trade mix, what does it mean?
That means you are only limited to one industry. Your tenant pool, your rentability also limit to just one. I would say this is the most important among these 70 framework.
How does it relate to Gate Plus?
Gate Plus, because there is no restriction of the approval usage. Of course, B2 usage, manufacturing and all that are able to come in. You're not just selling into one type.
We have talked about everything so far. You realize that actually this is the exact thought process we use whenever we want to select a good industrial property. But of course, if we are based on Gate Plus, it's a brand new project. So in terms of tenure, it would definitely be able to fulfill under a leasehold property. But there might be some of you who is watching this video right now comparing between an older resale industrial property. So this is where things can get a little bit more touchy because a lot of these properties are at the 5 to 10 years mark or even the 15 years mark. So is it actually a safe property for you to even consider or not? So when it comes to leasehold property, this is actually very touchy, which we will not be able to talk about more in this video because based on today's point of filming, it's already 1 hour plus. It goes back to this. I think that if you have any questions on how to review this type of property, you can reach us via our contact number here. Tada! Both of us same, so you can reach us here.
Correct.
And we'll be happy to talk about more. So anything else you want to talk about?
Nothing. Then we will continue back our next episode 3. So do stay tuned to our this video channel.
Remember to like and subscribe to our channel. Otherwise, if you are looking at Gate Plus as a potential investment property as well, you can reach us because based on today's point of filming, there are still property prices that start as low as 800,000, which means down payment is about how much?
Less than 200.
170,000. So if you probably just don't want to incur any more ABSD, right? So this could be a choice that you can go for as well.
Or if you are already looking at some of the industrial property and you just need some of the pointers to let us go through the 70 framework, also can contact us directly.
Yep. So that's all from us. We'll see you in our next video.
Bye bye.